Hello everyone. The 16th largest bank of United States, the Silicon Valley Bank has collapsed. A bank whose total asset size as of 31st December 2022 was about $211 billion, roughly equal to about 17 lakh crore Indian rupees, whose net profit, if we ignore the mark to market losses, was approximately $1.5 billion, 10,000 crore rupees, 17 lakh crore total assets, 10,000 crores total profit. And yet, within a period of 3 months or about 2 months, the bank collapsed. Well, where else could a common investor trust to put the money but the bank? Therefore, the collapse of Silicon Valley Bank is an alarming bell, not just from the angle as to what is going to follow further in United States, however, from the angle that for a common investor, for the stock markets, for the people in general, for the nations in general, the single most reliable source of keeping their money is fixed deposits in banks. And if bank itself are at risk of such vulnerability that quite fine about 3 months back and then suddenly dead in 2.5 months, then where does the common man go? Hello everyone, my name is Gagan Singh and I am here today to talk about Silicon Valley Bank collapse and what were the reasons it happened, what are the implications, what is the way forward, and how you as an individual, irrespective of whichever profession you are from, whichever stream you are from, should do certain steps to ensure that your risk can be mitigated. In this video, I'll try to cover 5 topics. Number 1, what happened exactly? Number 2, why did it happen? Why did the bank collapse? Number 3, who are the ones who are going to suffer? Number 4, what are the likely implications for the country of India? And finally, number 5, what are the important implications for all of you, all of us? What actions could we do to hedge our risk? So let us begin the video by topic number 1. What exactly happened? Now, here, I like to quote a very legendary Indian banker, the chairman of one of the big Indian banks whom I once met. And he said to me that banking is a very easy business. We are simply supposed to open branches and thereafter depositors would come and make deposits. Well, of course, that was on a lighter tone. However, banking has some very deep challenge. To understand this deep challenge, let me show you a simple illustration. I want all of you to look at this chart on the screen. Now, this chart is showing 3 very simple terms. On one side, you can see where does a bank get its money from. Well, there are many sources, but to keep it simple, we are going to talk about the most popular source, which is deposits. Now, deposits could be something which is made by an individual investor, which maybe is a part of a saving deposit. Deposit may have come as a fixed deposit, or it could be a current account. So, deposits constitute the bulk of a bank's liability, which means how a bank gets money. Thereafter, on the other side, you will see the entries as to where does the bank invest them. And while here also there could be many things, but let us focus on 2 most important things. First is loans. The deposits which a bank receives, it then converts them to loans by giving loans to organizations, corporations, individuals, people who are running businesses. And whatever money remains, bank is supposed to then invest. Now, some of the investments are statutory obligations. So bank may have to park some money with the central bank or it may have to keep some statutory liquidity ratio. But most of the investments could be in government bonds or in equity market, which is based on the bank's policy. The model works in such a way that the deposits which are received are typically at a lower interest rate. So on an average, if a fixed deposit rate, let us assume in India's context right now, is 7%, and a current account is usually without any interest cost. So the weighted average cost of the money which banks receive is, let us say, 5% to make the example simple. And the loans which the bank gives to corporations, industries at the rate of say 12%. So this gap of 12 minus 5 becomes a spread how bank makes money. Of course, investments also earn money for the bank, but investments if made in government bonds would typically fetch a return of 5%, 6%. So it's more or less at par with the deposit rate or just slightly above it. Therefore, loans become the crucial component of banks making money. So very nice model, as the chairman said, very wonderful model. So what's the problem here? The problem here, my friends, is the date of maturity. Now, technically, deposits have some date of maturity. So a fixed deposit could be getting matured at 5-year tenure, 7-year tenure, 3-year tenure. Or if a consumer wants, he could just walk into the bank and say, no, I need the money. Please give me the FD, mature it right now, cancel it and give me the money right now. So the deposits, which are the source of fund, may have a theoretical maturity date. However, the customer has an option to call back the money immediately and a bank is obliged to pay it immediately. On the other hand, The assets which the bank has built, both the loans which are given to companies and the investments, may not have an immediate recall possibility. The loan given to corporations may have a clause that the company has to give the loan when the bank asks. However, most corporates don't work like this. They won't have enough money to pay the bank back. So the loans may take time to come back in time of emergency. And of course, investments. Suppose bank has invested in equities or government bonds. Now, while the bank can sell them in most of the cases, but in those cases, it could make a loss. Therefore, the riskiest component of a bank is that the money which is coming into the bank can be called back anytime. But that money which is being invested by the bank doesn't have such an option and could have a longer tenure. This mismatch of liquidity, this liquidity imbalance, is a potentially great risk which could lead to something which is called a run on the bank, which means suddenly if there is a panic and depositors feel that this bank is very risky, all of them in today's social media age would come to know it in like almost no time. And they'll queue up at the bank asking that please release my deposits immediately. And sometimes it could happen that even within one day, there could be millions of investors queuing up for withdrawal. On the other hand, in such a short time, bank would have no way that bank could manage all of its loans to be recalled back, all of its investments to be sold and money to be generated. And that is when a run on the bank happens and the bank collapses. In the past, in India, if you look at the history, it happened with Yes Bank, and that can lead to complete collapse of the bank. Precisely such a thing has happened in the case of Silicon Valley Bank. And to be specific over here, Silicon Valley Bank had deposits of about $174 billion. Yes, you heard it correct. We are talking about an amount which was roughly speaking about 12 to 30 lakh crore. Its loans were to the tune of $74 billion. And it had investments in government bonds which were $91 billion. Now, as the investor confidence started eroding, as the depositor confidence started eroding, there was a huge queue. And it is said that on the D Day, there was a demand of about $45 billion of withdrawal, which the bank didn't, of course, have. And therefore, that is when the government stepped in and the bank collapsed, which meant that $174 billion of deposit got stuck up over there. However, it's not just that. The $74 billion of loans which have been given are quite often not yet handed out to the corporations. So a company has set up a tech startup and they have taken loan from the bank, but the loan hasn't been dispersed. It's still being lying with the bank. So effectively, you have $174 billion of depositors who are getting affected. And out of the $74 billion loans which were on the books, there may be many companies who also get stuck up. And all of this happened at this bank in a period of less than 1 week. So therefore, this run of the bank which led SVB to its disaster is something which put both the depositors, the people whom they had given the loan, in great problem. And this is what has happened right now. The reason it is huge is because Silicon Valley Bank has a history of more than 40 years. It claims to be catering to 50% or more of tech startups in Silicon Valley. And Silicon Valley is, of course, globally famous because of the various technology-based advancements. The great companies like Apple, Microsoft, and so many others have their home over there. So a bank which led to the growth of the entire IT technology world, which was the backbone, collapsed, which means the entire startup space, the entire growth of technology-based innovation is today at risk. That, my friends, is part number one as to what has happened. Now, let us go into the second part, that why did this collapse happen? For that, I like to give you a term called swing, SWING. The concept of swing goes, the first S is the so-called startup winter. Now, Silicon Valley Bank had been essentially lending to startups in technology space. Now, because of the coronavirus-induced crisis, coronavirus-induced lockdown, globally governments had launched stimuli. Stimuli meant that at almost zero interest rate, government was lending huge money to various corporations to increase their businesses. And bulk of this money went to IT sector because suddenly online was the vogue, technology was booming. So around this period in 2020, 2021, when the interest rates were near zero, numerous startups mushroomed. And of course, Silicon Valley Bank was at the helm of everything. So any new IPO would come, let's say they would raise 100 crore rupees. Now, of course, they won't take 100 crore rupees with them on their home or in the company office. All of this money was parked with Silicon Valley Bank. And so on, their deposits started increasing. It is said that their deposits increased almost 3 times from roughly about $60 billion to close to about $180 billion during this 2-year period of coronavirus. The problem thereafter was that the loans which they used to disperse earlier were now falling. And why were the loans falling? Because essentially most of the companies were able to raise equity. So loan demand was limited. So you have a situation where suddenly you have about, let's say, $175 billion of deposits where you have to pay interest. On the other hand, the loan amount as of 31st December 2022 was only $74 billion. So your real income generating source is less than half of your liabilities. So you have about $100 billion excess, and what to do with that? And what they did in 2022 was invest it in so called government bonds, which are long term mortgage backed securities, which are almost zero risk. So this is the picture which happened. But then the problem started from 2022 onwards when the startup funding winter started. Now, this was the time when COVID had abated and online was also in a recessionary mode, slowing down, and therefore technology firms started receiving a shocker. Interest rates were getting more expensive, and therefore startup funding euphoria, which existed in 2020, 2021, started eloping away. And that's the time when startups started feeling the crunch. All the money which they had deposited, they now needed it. Why did they need it? Is explained in the second two, which is W. The W of swing is withdrawal. So till this period from 2020, 2021, even some part of 22, the tech-based startups were depositing money. But when the interest rates started to increase, new equity became difficult to come by. The startups thought that it is better to withdraw their deposits, which are kept with Silicon Valley Bank. So, of course, they started asking for their deposits back. And once this started happening, more prominently in the second half of 2022, that is when this W of swing hit Silicon Valley Bank very badly because the withdrawals were proving painful. And why were the withdrawals proving painful is explained by number 3I, which is investment sell off. Now, this part is very important. The Silicon Valley Bank had invested about $91 billion in long term maturity bonds. When they had invested this money in 2020-21, the average yield which they were getting was 1.79%. Why? Because interest rates were very low. And now, in 2022 second half or 2023 earlier part, within a period of about 1 year, United States Federal Bank had increased the interest rates from almost 1% to close to 4.75%. So about 400 basis point increase had happened in a period of 1 year. And once your interest rates increase, the value of your bond falls. Now take note that this value on bond will fall only when you are selling it. You could keep the bond till its maturity and get your original money back. However, because the depositors were asking for withdrawal, they were saying, come, give me my money back right now. So Silicon Valley Bank had no option but to start selling that investment of its long-term mortgage-backed securities. And that's where they started having losses. The investment of about $91 billion on mark-to-market had approximately $15 billion of loss because the 1.79% yield which their bonds were giving was in today's contemporary situation about 3.79% in the market situation. Therefore, their assets had been shorn off approximately $15 billion of value, and every time they were selling it on a loss. And because of this demand of depositors to withdraw, they had to do the third I, which is investment sell-off, which they basically the bond selling. They had to sell approximately $21 billion worth of bonds, which made them incur a loss of $1.8 billion. And once that happened, at that juncture, they had no other option but go for fourth N, which is new capital. They came up with a proposal to go to the market and get new capital of about $2.25 billion. However, this proposal failed. Why did this fail? Because in general, the news had spread across the market that Silicon Valley Bank is in trouble. Its entire equity is almost nearly wiped off. And once that happens, in banking sector, trust is such a vital thing that nobody would give you money. So the new capital generation scheme failed. And that is when the bank collapsed. There was a run on the bank. And the fifth G was, of course, when the government intervened and the government sort of put a lock on the bank, put it on a frozen state. That is where the Department of California for Financial Protection came into the picture, DFPI, and they handed over the bank to FIDC, which is Federal Insurance Deposit Corporation or Federal Deposit Insurance Corporation. And so what FDIC did was that they froze the bank accounts. They established a new bank called National Bank of Santa Clara, and they shifted all of this bank's funds, finances as it is to this National Bank of Santa Clara. And that is where the collapse finally culminated around 10th of March. So, what is important to understand is that the concept of swing started a few quarters back in terms of the startup winter, leading to W of withdrawal. Thereafter, forced investment sell off because of imbalance of liquidity. People are asking their money, there is no way to pay the money, and therefore they have to do the third I, which is investment sell off. Then, N, new capital generation also failed, and that's when the government set in and the bank collapsed. So, this was something which explained what has happened over here, an alarmingly short period. Now, let's come to the third part. Who are the suffering parties over here? Well, for that, it's important to understand that fortunately, there is a policy which is called deposit insurance policy. Now, this deposit insurance policy, however, has a caveat that in United States, it only protects deposits of up to 2.5 lakh dollars, which is about roughly 2 crore Indian rupees. And unfortunately, only 15% of the depositors of Silicon Valley Bank were in this category so that they are fully protected. The other 85% were big corporations who had probably invested like tens of millions of dollars, which they may have picked up from their equity offering or from various other loan projects and parked it in Silicon Valley Bank because, after all, it was the most trustworthy bank. Now, what happens to this money? It's important to understand that. Recently, Joe Biden, the US president, has made a statement that the government will do everything possible to ensure that the depositors are not harmed. But is that encouraging? Is that encouraging? 15% of the depositors are protected under the 2.5 lakh dollar cap. The answer is no, because the bank's accounts have been put to a freeze. This means that the big settlement now could take 1 day, 1 week, 10 days, 2 weeks, 1 month, 3 months, because government processes do take time. Till that time, the depositors who had put $174 billion over here are stuck up. Also, the companies who had got loan sanctioned with $74 billion worth of loan, they are also stuck up. They have to pay their salary, they can't do that. They have to pay their office rent, they can't do that. They have to run the business with working capital, they can't do that. So this situation puts all the depositors, all the companies which were banking with Silicon Valley Bank in a serious risk. Because my friends, today's world is very competitive. You can't run your operations for a few months, your competitor is going to kill you, especially in the present tenure when tech world is facing a very serious restructuring situation. And therefore, this Silicon Valley Bank collapse has wreaked havoc, a catastrophic havoc on all the lenders, all the depositors, which could probably have its reach to lakhs of working professionals in United States. And not just in United States, in various other countries. In India also, it is said that about 20 odd startups have their funding from SVB. And so in that sense, the entire ecosystem, the entire paraphernalia of companies in the startup ecosystem could be damaged. Why do I say the entire? Because there are other companies or banks which are lending to the startups. So they would also now really be watching this with great caution. And that could practically lead to annihilation of a layer of companies which had been relying on funding from SVB or its associated companies. Therefore, it's something which has to be taken with very, very serious implications in the times to come. Now, let's move on to part number 4, which is that what are the likely actions which US government could do now? And also, we'd like to briefly analyze that where is it that the government may have gone wrong. Now, it's important to understand from this episode, and the most alarming learning is that a very healthy bank with no malafide practices could probably get bankrupt overnight just by liquidity imbalance. So, the first important thing with the governments, not just in US but across the world, will have to ponder over is that no matter how much we privatize the banking system, how much we look at the banking systems in isolation, in reality, a damage to one bank can lead to the collapse of multiple banks. It could lead to the damage to entire confidence of investors on the banking system. Therefore, it becomes important to have strong federal regulations which are observing what is happening in each of the banks. Second question goes is that liquidity norms. In India, we all know CRR is about 4.5%. CRR is the money which banks have to keep with RBI. And SLR, statutory liquidity ratio, is the money which banks have to keep as part of a certain percentage of their liabilities in certain liquid assets. So that were there to be a run on the bank, then banks could sell that money and pay it back. So SLR is 18% right now. Therefore, the second important message is that CRR and SLR ratios have to be kept at a conservatively protected level because you never know when the investor confidence may collapse. And the third important virtue or the important concept which has to be practiced is close international coordination. Today, the world is deeply interconnected. A collapse in US could lead to another one EU. Another one in EU could lead to another one in India. Therefore, global financial monitoring mechanism is now imperative, which is where the role of bodies like IMF, World Bank, or greater, closer intergovernmental cooperation will now come into play. So, what happens now is that as of now, the so called National Bank of Santa Clara is trying to find a possible buyer. And it's quite possible that in days to come they may find, so you are likely to hear more about them. But till then, everything is frozen, and Federal Bank and the US government is now in a firefighting mode. Which then brings us to part number 5, which is that for India and for all of us as individuals, what are the likely lessons over here? So, a very important lesson for India or for any other country is when we launch stimuli, it generally becomes very important, and the government is in high pressure to start dispersing loans without maybe doing enough scrutiny about the sustainability of the loans. In 2020, 2021, the zero interest regime became the greatest culprit. And because of that evil, which was originally intended to be good, ended up turning up evil, is where we are standing. The crisis has happened because of that. Therefore, in situation of stimuli, when zero interest rate regime is maintained, governments have to be very careful, not just of lending the money, but to be careful that where are they lending it. And Indian government, of course, the stimuli phase is over, had to take care because it is, of course, happening that the banks had NPA. The Indian government has worked a lot of NPA problem has been resolved. However, this is an ongoing process. So government would have to keep a real close eye on the NPA of banks. The second is interest rate hike implications. Now, when the central bank, in India's case RBI, increases monetary policy interest rate, what happened with SVB in USA could happen with Indian banks. So if Indian banks have invested in long-term maturity government yield, government bonds, then as the interest rates go high, the value of those bonds will crash. So banks will of course suffer losses, which therefore means that the interest rate increase, which is inspired by the desire to curtail inflation, also has a serious side effect of losses for those who have been investing in bonds, which once again means central bank like RBI has to weigh in the risk of a bank bankruptcy while increasing the interest rates. Very soon, we'll have another monetary policy meeting in early April. Already, the Indian banks have now passed on the kind of increase because RBI has increased its repo rate by approximately 250 basis points over the last 1 year. And there is talk that another increase of 25 to 50 basis point may happen because inflation is still at a dangerous zone of about 6.4% as of the February statistics. But because of the collapse of SVB, now RBI may have to think very carefully whether to increase the interest rate in April or not. The third important thing which India may have to review is its CRR and SLR ratios to try to have certain sufficient and conservative numbers so that in an emergency, banks can take a recourse. And finally, a cross bank RBI fund, which can be for emergency situations. These funds were used in the past in Yes Bank case, IIFL case. So the central bank needs to maintain a corpus because one bank's collapse can trigger a domino effect, which can kill other banks also. Now, this, my friends, brings me to the last part of this video. And the last part is the most important, the alert concept. So even if you have probably gone through the entire video, please pay greatest attention to this last part, which is alert. The alert framework tells that what do you all as potential depositors should always be doing. The A of alert means always carefully assess which bank are you investing your money in, which bank are you making an FD in. So please check the health of the bank, check their balance sheet, find out that what is their profitability, find out what are their NPAs, make sure that bank is not just profitable but reasonably liquid. So that is the onus of a potential depositor, to always assess very carefully. The second L is all about large. Now the large here means that whichever portfolio, whichever sector you're trying to invest in, make sure that invest in the larger companies. So you want to make FDs in the banks? Well, go for a larger bank. Now this may sound a bit controversial because after all, there are many small banks which are doing very well. So what I would like to say over here is, suppose as a demonstration, if you have 10 lakh rupees and you want to make a FD of that, then in India, FDs are insured to the tune of 5 lakh rupees. So you may want to choose your banks carefully and invest in the larger banks, make deposits in the larger banks, simply because when a big crisis happens, larger banks are more likely to tide off the crisis. They are more likely to have a strength to weather the storm, where the smaller banks may collapse. So go for investing in larger banks so that your funds are protected. The E is expand. Now, expand here means that make sure that you're not just investing in one bank. You make FDs in smaller amount in different banks because in India, as we all know, we are insurance covered to the tune of 5 lakh rupees, which means if you have a FD of 4 lakh rupees, you'll get 4 lakh rupees as an insurance, although it may take a time. If you have an FD of 10 lakh rupees, you'll get only 5. But if you had invested 5 lakh in one bank, 5 lakh in another, 5 lakh in another, then if they all collapse, then you will still get 5 because each bank and each investor's FD is insured. Then R is about risk management. Now, risk management basically means that when you are investing, be careful to diversify your portfolio. Don't put all your eggs in one basket, which means not just FD. Here, you diversify into gold, you diversify into real estate, you diversify into some various bonds by yourself, you diversify into equity. Because at the end of the day, a balanced portfolio is something which will keep you safer and optimum risk management up to your taste. And finally, T, and most important, is tactful finance management. Now, by tactful finance management, what I mean is please manage your expenses. Well, whether it may happen or not, but as of now, the forecast goes that the globe is heading towards a recession. And in these moments, it becomes very important that if SVB has collapsed today, another bank could collapse tomorrow. Already we know that Signature Bank has also collapsed, and the US government had to support the First Republic Bank, the Pacific Western Bank, to ensure that they survived. So, tactful management of expenses means that make sure that your income is always greater than expense, because there is no better way to ensure financial sustenance than ensuring that your expenses are lower than income. So please follow these alert principles to ensure that your money remains safe and in your pockets. So this is Gagan saying, I'm signing off for the day. If you like this video, please press the like button, subscribe button, and stay tuned because we'll be coming back with more videos to help you ace your interviews and group discussions.